Many folks think paying 24% on a Roth conversion is simply too much, and I'm here to tell you they might be wrong. And that mistake could cost their surviving spouse over $13,000 a year in extra federal taxes. It could cost their kids even more. Here's the question you should be asking. Is 24% lower than the rate your spouse will pay after you're gone? Lower than the rate your kids will pay when they inherit your IRA, and lower than the rate the IRS will force on you when RMDs actually start. For many people with significant IRA balances, the answer to all three is yes. And by the end of this video, I'm going to walk you through the exact math on all three, including a side-by-side comparison that shows how the same $245,000 in income gets taxed completely differently depending on how you file. I'm Mark Fonville, a certified financial planner at Covenant Wealth Advisors. One of the most common planning conversation we have is exactly this: whether a Roth conversion makes sense and at what rate. So here are 5 specific reasons why 24% can be a bargain for you and your family. Now, reason 1 is the widow's tax penalty. This is the one that blindsides surviving spouses every single year. When one spouse dies, the survivor can file jointly for that tax year and may be able to use qualifying surviving spouse status for up to 2 more years if they have a dependent child, which is rare for this age group. But after that, the survivor is filing as single. And here's the part that often catches people off guard. Single filer brackets are roughly half the width of married filing jointly brackets. Look at the 24% bracket, for example. For a married couple, it covers income from $211,401 to $403,550. That's almost $192,000 of room. For a single filer, just $105,701 to $201,775. That's half the space. Your surviving spouse still collecting pensions, Social Security, and now drawing from a larger inherited IRA balance gets squeezed into brackets that are half as wide. Income that was taxed at 24% for both of you can jump to 32% for one of you. And I've sat across from widows and widowers who had no idea their tax bill just went up by 5 figures. So let me put real numbers on this for you. Say your adjusted gross income is $245,000, married filing jointly with the standard deduction. Your federal tax, that's $36,268. Now take that exact same $245,000 in income. But now you're filing as single after a spouse passes. The tax jumps to $49,704. That's $13,436 more in federal tax on the same income. So why? Why does that happen? Because you've gone from the 24% bracket to the 32% bracket, and less of your income is taxed at lower rates. Same money, completely different bracket structure. One of you will outlive the other. This isn't a worst-case scenario, it's a near certainty. If that $13,436 number surprised you, by the way, take a second and hit the like button. It helps more people in your situation find this video. Now, reason number 2, the Secure Act and your kids' tax bill. Before 2020, your kids could inherit your IRA and stretch distributions over their entire lifetime. The Secure Act eliminated that for most non-spouse beneficiaries. Now your adult children have just 10 years to empty the account. So think about the timing. If you're in your 60s, your kids are likely in their 30s or 40s, right in the middle of their peak earning years. Let's say your daughter, for example, earns $150,000 and inherits an $800,000 traditional IRA. Spread evenly, that's $80,000 a year in added ordinary income for a decade. She didn't ask for that tax bill. You didn't mean to leave it for her, but the IRS doesn't care about intentions. As a single filer, $230,000 in income likely pushes part of her taxable income into the $32,000 bracket every year for 10 years. Now, compare that to a Roth IRA. Same $800,000, same 10-year rule, but the distributions are generally tax-free if the Roth has satisfied the 5-year rule. No added income, no bracket creep, and she can let it grow for the full 10 years before touching a penny. You pay 24%, she pays, or she would have paid 32% on a significant portion. The potential savings from converting while you're in the 24% bracket, tens of thousands of dollars over that window. So those first two reasons are about protecting the people you love. The next two are about protecting yourself, specifically from two costs that many people don't see coming until it's too late. And the second one, the Medicare cost, has a cliff structure that can cost you thousands if you're even $1 over the line. Okay, reason number 3 is the RMD time bomb. If you're between 60 and 75 right now, you're probably in what I call the gap years. That window between the end of your working income and the start of what we call required minimum distributions. And these may be the lowest tax brackets you'll see for the rest of your life. Time will tell. Now, because at 73 or 75, if you were born after January 1st, 1960, the IRS starts telling you how much to pull out of your traditional IRA, whether you need the money or not. So here's what the math actually looks like. Say you and your spouse have $1.8 million in traditional IRAs at age 63, and you don't do any Roth conversions. If that money grows at 6% a year, it could be worth about $3.6 million by age 75. Under current law, age 75 is when people, again, born after January 1st, 1960, must start required minimum distributions. Using the IRS life expectancy table, your RMD could be around $140,000, all taxed as ordinary income. Now, stack that on top of pensions and Social Security and other income, and you may find yourself in a much higher bracket than you ever expected. And the pressure doesn't stop there. As you get older, the IRS divisor gets smaller, which forces even larger distributions over time. Every dollar you convert now at 24% is just a dollar the IRS can't force out later at 32% or higher. Roth IRAs have no RMDs during your lifetime. You choose when and whether to withdraw. Now, reason 4, the Medicare IRMAA cliff. Most people know Medicare isn't free, but here's what surprises a lot of folks. Your Medicare premiums are tied directly to your income from 2 years ago, and the system uses a cliff, not a gradual scale. Now, cross the line by just $1 and you pay the full surcharge. For a married couple in 2026, the first IRMAA threshold is $218,000 in MAGI. Go $1 over that, and you and your spouse each pay roughly $1,000 more per year in Medicare premiums. That's over $2,000 annually just for crossing the line. And the surcharge just go up from there. At the next tier, you're looking at even more, and these hit every single year. So here's the connection. Traditional IRA distributions, including RMDs, count toward your MAGI. Qualified Roth distributions do not. So every dollar you convert now means a smaller future traditional IRA, smaller future RMDs, lower future MAGI, and potentially lower Medicare premiums for years. And yes, the conversion itself bumps your MAGI in the year you do it, but that's a known controlled cost you can plan around. The alternative is uncontrolled RMDs triggering IRMAA surcharges every year for the rest of your life. A short-term IRMAA hit to avoid decades of IRMAA hits? That's a trade worth considering, in my opinion. Reason number 5, tax-free compounding and protection for your survivor. This last reason is the one people really underestimate because the payoff is quiet, but it is relentless, and it ties back to everything we've already covered. Here's the truth about your traditional IRA. You don't own 100% of it. You own your balance minus whatever your future effective tax rate turns out to be. The IRS has a silent claim on every dollar of growth. When you convert to a Roth at 24%, you settle that claim once. From that point forward, every dollar of growth belongs to you. No future tax, no bracket risk, no forced withdrawals, at least under current law. Now, let me put simple numbers on it for you. Convert $150,000 at 24%. You pay, let's say, $36,000 in tax. That $150,000 now sits in a Roth IRA. At 7% growth for 15 years, just for illustration, by the way, that becomes roughly $414,000. The $264,000 of growth, well, it's entirely tax-free. So in a traditional IRA, that same $264,000 would be taxed on the way out. At 32%, that's about $84,000 in future taxes just on the growth. Now, in this illustration, $36,000 in conversion tax today could avoid substantially more in future tax. And the longer you let it compound, the wider the gap gets. But here's what makes this even more powerful when you connect it to reason number one. If your spouse inherits this Roth IRA instead of a traditional IRA, there are no RMDs forcing money out, no bracket squeeze as a single filer, and no IRMAA surcharges. The tax-free growth isn't just about you, it's about protecting the person who outlives you. Now, here's what all 5 of these reasons have in common. The biggest consequences don't show up on this year's tax return. They show up on your spouse's return, your daughter's return, your own return when RMDs kick in, your Medicare premiums in your 70s and your 80s. The question isn't whether 24% is a good rate. It's whether 24% is lower than the rate that's coming next. How much to convert, when to convert, and how to manage the tax bill, those depend on your specific numbers, your income, your IRA balances, your spouse's situation, and your estate plan. If you have over $1 million in retirement investments and within 10 years of retirement, my team can just do your retirement planning for you. You can book a complimentary strategy session at covenantwealthadvisors.com or just click on the link in the description below to find out if you're a good fit. If this helped you see Roth conversions differently, drop a comment below. I'd love to hear which of these 5 reasons hit hardest for your personal situation. And I'm doing a deep dive, by the way, on widow's tax penalty in an upcoming video, which is exactly how to calculate it for your specific filing situation and what you can do about it now. So subscribe to that video to be sure it shows up in your feed when it goes live. Thanks so much for watching. Take care.